September 2000, Dallas, Texas. Reed Hastings and Mark Randolph are sitting in a conference room on the upper floors of Blockbuster's headquarters. The building is massive. The furniture is expensive. Everything about the place signals dominance. At this moment, Netflix has roughly 300,000 subscribers. Blockbuster has tens of millions. Netflix is losing money every month. Blockbuster has just reported billions of dollars in annual revenue. This meeting took months to arrange. When the invitation finally came, it arrived with less than a day's notice. According to later accounts, the Netflix team flew to Dallas early that morning, paying for travel they could barely afford. Now they're sitting across from John Antioco, Blockbuster's CEO. Netflix is here for one reason. They want Blockbuster to buy them. Not for billions, not even for hundreds of millions, for around $50 million. The figure varies slightly depending on the source, but the scale is consistent. $50 million to save Netflix from collapse. Antioco listened. According to people who were there, the offer was not taken seriously. Netflix was viewed as a small, unprofitable DVD by mail service, a niche experiment, not a meaningful threat. From Blockbuster's perspective, that reaction made sense. In September 2000, Netflix was not David facing Goliath. Netflix was a fragile startup operating in the shadow of a giant. The company had launched in 1998 as a DVD by mail service. Customers ordered movies online. Netflix mailed physical DVDs in red envelopes. The problem was the economics. Netflix was losing large sums of money. In 1999, the company reportedly lost close to $30 million on just $5 million in revenue. In 2000, losses increased, with expenses far outpacing income. Exact numbers vary by source, but the pattern is clear. Growth was making the problem worse, not better. The dot-com bubble had just burst. Tech stocks were collapsing. Venture capital funding had dried up almost overnight. Netflix had attempted to go public earlier that year. They pulled the offering. Demand simply wasn't there. Internally, leadership understood the situation was serious. They did not have unlimited runway. Meanwhile, Blockbuster was still thriving. Over 9,000 stores worldwide, presence in nearly every American town, exclusive relationships with major studios. The pitch Netflix made that day was, by their own later admission, bold. Netflix would handle the online business, Blockbuster would keep the stores, they would share the upside. Barry McCarthy, Netflix's CFO at the time, later described the pitch as chutzpah. When the $50 million figure was mentioned, executives in the room reportedly struggled to see the value. Ed Stead, one of Antioco's advisors, later said he believed the dot-com frenzy had been exaggerated and that online businesses were fundamentally unstable. The meeting ended without progress. Antioco was right about one thing. Netflix was unprofitable. The dot-com crash was real. $50 million likely did seem expensive for a company mailing DVDs at a loss. What nobody in that room fully understood was that both companies were about to make decisions that would change their futures in opposite directions. The return trip to California was subdued. By later accounts, the Netflix team understood something important. They were not getting rescued. There would be no acquisition, no lifeline from a larger company. If Netflix was going to survive, it would have to do so alone. This is the part most people misunderstand. What saved Netflix was not brilliance, it was survival discipline. After the Blockbuster rejection, Netflix had very few options, so they focused on stopping the bleeding. In 2001, Netflix laid off roughly 1/3 of its staff. They reduced marketing spend. They renegotiated studio agreements. The goal was simple: reach positive cash flow. By the end of 2001, Netflix reported its first profitable quarter. It wasn't impressive, but it bought time. In May 2002, Netflix attempted an IPO again. This time, it worked. They went public at $15 a share. But even then, Hastings was already looking past DVDs. Broadband speeds were improving slowly. Video streaming was technically possible, but barely usable. The infrastructure wasn't ready. Consumers weren't asking for it. Netflix began investing anyway, quietly, patiently, years before it made sense. In January 2007, Netflix launched Watch Now, its first streaming product. The library was limited. It only worked on certain computers. The quality was poor. By most accounts, the product was rough, but it was real, and it was included for existing DVD subscribers. Here's where the story becomes more complicated. Blockbuster did not ignore Netflix. John Antioco recognized the threat earlier than many people remember. By 2004, Blockbuster launched its own DVD by mail service. Then, in 2007, it introduced Total Access. Customers could rent DVDs online, return them in stores, and immediately get another movie. It was a strong hybrid model. For a period, Total Access performed well and applied real pressure on Netflix. Reed Hastings later acknowledged that Blockbuster was competing aggressively. At one point, Blockbuster even mailed Hastings a kitchen sink as a joke. Internally, Netflix was concerned. Hastings reportedly revisited the idea of selling Netflix's online business to Blockbuster. Then, Blockbuster's internal conflict escalated. In 2005, activist investor Carl Icahn acquired a significant stake and joined the board. He strongly opposed Antioco's strategy. Total Access was expensive. Eliminating late fees threatened a major revenue stream. Icahn pushed for cost-cutting and short-term profitability. The conflict became personal. In 2007, following a dispute over compensation and strategy, Antioco left the company. His replacement, Jim Keyes, shifted focus back to physical stores. Total Access was scaled back, prices were raised, late fees returned. Keyes believed Blockbuster's strength was its retail footprint. But then the 2008 financial crisis hit. Blockbuster was carrying roughly $1 billion in debt. As credit tightened, movie studios demanded faster payment terms. According to Keyes, this drained hundreds of millions in working capital in a short period. He later described it as a liquidity collapse. In September 2010, Blockbuster filed for Chapter 11 bankruptcy. The company was sold to Dish Network in 2011. By 2014, corporate stores were gone. Today, one franchise location remains in Bend, Oregon. Netflix survived, then scaled. By 2010, Netflix had roughly 20 million subscribers. Streaming was overtaking DVDs. In 2011, Hastings attempted to split the company into two services. The backlash was severe. Netflix lost about 800,000 subscribers in a month. The decision was reversed, but the direction remained unchanged. Streaming was the future. Then Netflix made another risky bet. They began funding original content. In 2013, House of Cards launched. It worked. Netflix became a studio, not just a distributor. By 2016, they reached 100 million subscribers worldwide. Today, Netflix serves over 260 million paying users, with annual revenue exceeding $30 billion. John Antioco left Blockbuster in 2007. Later, he bought Netflix stock. He has said he recognized that Netflix had a clear path forward. He sold the shares after they doubled. In hindsight, Holding longer would have changed everything. Carl Icahn later called Blockbuster
the worst investment I ever made.
He acknowledged that replacing Antioco may have been a mistake. Reed Hastings later summed it up simply: if it hadn't been for their debt, they could have killed us. This story isn't about innovation beating old business models. In 2000, Antioco was not foolish to dismiss Netflix. In 2007, Blockbuster was arguably winning. The real lesson is narrower. Debt removes margin for error. Blockbuster could not survive a single bad year. Netflix survived because it stayed small, flexible, and solvent long enough for the future to arrive. This isn't a story about innovation. It's a story about endurance. Netflix survived by pivoting when it had no choice. Blockbuster died with millions of customers because time ran out. Sometimes being right isn't enough. What matters is whether you can outlast everyone else. And that one Blockbuster still standing in Bend, Oregon? It isn't nostalgia. It's a reminder of what happens when you laugh instead of listening.